Good day from anywhere you might be listening again, and welcome to another session of tutorials. We are looking at IS 23 borrowing cost, and then um, the overview. Like I've always been telling us, whenever we are looking at any standard, we look at the overviews, we look at the recognitions, and then the measurements, as well as the presentations and then the disclosure. So, quickly, let's look at the overview of borrowing cost IS 23. Now, IS 23 is one of the standards that prescribe how to treat borrowing cost. In other words, it is one of the standards that tells us what exactly is the borrowing cost that can be added to the cost of an asset. In other words, that can be capitalized as part of the cost of an asset. And so it is expected that an entity is to capitalize any borrowing cost that is directly attributable to the acquisition, construction, or production of a qualifying asset. In other words, whenever you are acquiring or constructing or producing any qualifying asset, the part of the cost of that qualifying asset is inclusive of the borrowing cost. Therefore, you must understand that whatsoever borrowing cost that is not directly attributable or that cannot be directly, viewed as part of the cost of borrowing and to the acquisition and construction or production of any qualifying asset, they are not part of the cost that we are to capitalize. They are to be recognized as expense. And so that is just that for that. So what are borrowing costs? Borrowing costs are all the interest expense, amortization of discount or premium, finance charges on lease in lease contract, and any exchange difference arising from foreign currency borrowing. So whenever we are talking about borrowing costs, that interest that is being charged, that is directly attributable, as well as amortization of amortized discount and premium. When discount and premium always arise when you meet certain conditions, when you are borrowing a certain amount of money, usually from the finance house, if you are able to meet certain conditions, like they will tell you, if you are to pay, this is also part of the amount of the amount of the amount that you are borrowing, the principal amount that you are borrowing. If you are to pay the part of it, we are going to give you a discount on the interest. That is a discount on the interest. So if you pay that amount now before the due date, as it were, for instance, let me just give an example now. You borrow 500,000 naira from the finance house, it's being charged at 10%. Now the interest rate is 10%, as it were. Now it is expected that the loan will be paid back, let's assume 5 years time. The 500,000 will be paid back in 5 years time. And the one of the conditions may just be that the lender may just tell you that, okay, if you're able to pay this part of 500,000 in 2 years time, we are going to give you a discount on the interest that you are paying. That discount that they are giving to you, you are to amortize it over the number of year that the loan is going to be repaid. For instance, now you are to pay interest rate annually for 5 years. Now there is a condition. They will tell you, okay, if you are to pay the part of the principal, or they can even tell you part of the interest. For instance, the interest you are supposed to pay next year, now they will ask you to pay this year. And if you do that, they will give you a discount on the total amount that you are to pay back. You understand? That amount of discount that they are giving to you are to amortize over the period of the borrowing. So that amortization is also part of the cost of the borrowing, the cost of the acquired or constructed or produced qualifying asset. That is that for that. It's as simple as that. Just know it the way I've explained it to you. There is nothing difficult there. The next thing that we need to identify is qualifying asset. What are qualifying assets? Qualifying assets are assets that necessarily takes substantial period of time to get them ready for their intended use or for sale. Please take note of these words that is in this definition. An asset that necessarily, the word necessarily matters a lot. Necessarily takes a substantial period of time. Now take note of that thing or that one also, substantial period of time to get them ready for their intended use or for sale. Now, if you produce an asset today and you start using it today, it does not qualify as a qualifying asset. If you construct a building today, maybe under 2-3 months, it takes you time for you to construct the building and you are using it for your office, that is not a qualifying asset. A qualifying asset, they are assets that, they take necessary substantial period of time for them to be produced, for them to be constructed, and for the intended use or for sale, as it were. Good examples are building, not just anyhow building, all these edifices. Some edifices are there that it takes them quite a number of years for them to put them to bear. And then we have all these manufacturing plants. It also takes some substantial volume of numbers of years for them to get them to their intended use and or for sale, as it were. So please take note of that. Qualifying asset, they are assets that take necessary substantial period of time to get them ready for their intended use or for sale. Equally, it is important for you to understand the capitalization period. And when we talk about capitalization period, it is a period when the expenditure or the expenditure for the qualifying asset is being incurred and when it ends. That is, from commencement to cessation. That is the capitalization period. Meaning, you cannot capitalize any borrowing cost before the commencement of the construction or the production of the qualifying asset. Also, you cannot recognize or capitalize any borrowing cost when the construction or the production is complete. So take note of that, very, very important. So quickly, let's go to the recognition. Recognition now. For you to recognize borrowing cost in the financial statement, they must be, number one, directly attributable. Very, very important. They must be directly attributable. That is, they are directly concerned with a borrowing for the production or for the construction or acquisition of a qualifying asset. Very, very important. That's the key one. So please take note of that. Now, that is that for recognition. Now, let's go to the measurement. How do you calculate? I told you measurement simply means calculation of the value of an item. So, how do you calculate capitalization of a borrowing cost? Borrowing cost can be calculated by multiplying the capitalization rate, which can be the interest rate when it is being specific, or the general borrowing rate when it is being when we are using it average expenditure. Let me explain that to you. There are two kinds of layers of borrowing now. There are borrowings that are directly attributable. That is borrowing that is being specific. You are borrowing this amount of money for the construction of a qualifying asset. And then there is another borrowing that an entity will make. They call it the general borrowing. You understand? Not directly for the purpose of the construction or the production of a qualifying asset. But from that pool of borrowing, they remove funds to finance the construction or the production of the qualifying asset. So it's very simple. The capitalization rate can be the direct interest rate when it comes to specific borrowing, or the general interest rate when it comes to the borrowing, the general borrowing, which is not directly for the construction or the production of the qualifying asset. So whenever there is a direct borrowing, just use the interest rate. And whenever there is a general borrowing, you are going to do what we call, you are going to determine the weighted average of the expenditure that is being incurred. What do we mean by expenditure? It means that from the general pool of funds, you remove money per time for the expenditure, that is for the expenditure on the construction or the production of the qualifying assets. So those time that you are removing those funds, you are going to get the average of the expenditure. That is what we will now multiply by the general borrowing rate. So let's look at an example, very, very simple, and then look at it here. For instance, a company is building a factory. Now we are going to start with general borrowing now. A company is building a factory and the construction costs are as follows. In other words, the expenditure, the construction expenditure, that's why I said you are going to determine the average expenditure. So the construction expenditure are as follows. In January, they removed 10 million, and in March, they removed 20 million, and in June, they removed 30 million. Where are they removing all this money from? From the general borrowing. And they said the company general borrowing is 50 million. In other words, this company, they removed 10 million, 20 million, and 30 million from the general borrowing of the entity. So the capitalization rate from this question is the 10% annual interest. But you need to determine the average expenditure. So the first thing first is to determine the average expenditure. And how do you do it? It is by using what we call determination of the weighted average of the expenditure. So the expenditure in January, it was 10. So, and you understand that. Now, understand this rather. If it's the month at which they remove the money, it is on that month that you are going to pay the interest, as it were. Now, take for instance, if you borrow money now in January, you are going to pay interest from January to December. If you borrow money in March, you are going to pay interest only from March to December. If you borrow money in June, you are only going to pay interest from June to December. That is the meaning of determination of the average expenditure, as it were. You can do it directly. You can as well do it the way I'm going to teach you now, very simplified way. And how do you do it? First of all, you determine the average of the expenditure, and that is January. They remove 10 million from the pool of fund. In other words, they are borrowing 10 million from the pool of fund in January. So you are now multiply 10 million multiplied by 12 divided by 12. Why? Because they took the money in January. So that will now be 10 million. So you are paying, you are going to pay interest on this 10 million, because 10 million 12 divided by 12 is 1. 10 multiplied by 1 is 10. Then for the second one, they are taking 20 million in the month of March. If you count it, March, April, May, June, July, August, September, October, November, December, that's 10 months. So it will now be 10 divided by 12 multiplied by 20, meaning you use the money for 10 months. And then the last one is June, and that is June to December is 7 months. So 7 divided by 12. So all of this put together, you're going to get an average of 44.17 million. Then the second step is to multiply that is to determine the capitalized interest. That is the amount that will be recognized as the borrowing cost. And I told you from the formula, it is the capitalization rate. The capitalization rate can either be the specific rate or the general borrowing rate, multiplied by the principal if it's for specific, or average expenditure if it's a general borrowing rate. Let me put that down. Multiply by specific principal amount, or average expenditure. Capitalization rate, I told you it can be the specific interest rate, or the general borrowing rate. Please take note of that. Multiply by specific principal amount or average expenditure. So that is that for that. Very, very simple. Now, let's look at another question that has to do with specific interest rate. They say an entity constructed a building costing 100 million over 2 years. Now look at it. An entity constructed a building costing, they didn't say borrowing, costing 100 million. In other words, the cost is 100 million over 2 years. But they borrow 60 million at 12%. This is what we call specific borrowing. Specific borrowing. They borrow 60 million at 12%. So specific interest rate is 12%. Specific amount or specific principal amount is the 60 million. This one is direct. So for you to determine the borrowing cost, our capitalization rate will be how much? 12%, whereas the principal amount will be 60 million. And so 60 million multiplied by 12% will give us 7.2 million per annum. But they said the construction of the building is for how many years? 2 years, meaning that you are going to recognize 7.2 million for 2 years. And so what is the accounting treatment? Very, very simple. The accounting treatment is for the first year, which is the first year, you are going to debit the PPE with 7.2 million. You are debiting PPE with 7.2 million, and then you are crediting finance costs with the 7.2 million. That's for the first year. Then the second year, you are debiting 7.2 million to the PPE again, and then crediting the 7.2 million to the finance cost. That is the accounting treatment. Very, very simple, a standard. And that is what I want you to know. The standard are not what is difficult, but know it the way I've explained it to you, and then you will deal with it any day, anytime. Now, let's look at this very interesting illustration also. The MBLS is in business of plant construction. Over the years, they have not taken into consideration capitalization of borrowing cost. You have been drafted in as a professional consultant to check their books, and the information provided by the accountant for the current period are as follows. 1. That the company began constructing a new plant on March 1st, 2022 with the following expenditure incurred. Once you see this information, you should know that it will be tending towards general borrowing. Now, understand this, they may combine both the specific and the general borrowing into one question. All that you need to do is use the rate for the specific and get the borrowing cost. Use the borrowing rate as the capitalization rate for the general borrowing, or the general borrowing as it were, and then multiply by the average expenditure to determine the cost, and then if you add the two together, they become the borrowing cost for that particular period. But for this question, let's focus on what they are asking us. They give us the expenditure number 1 to be this and this and this. They said the company has a general borrowing. The company has a general borrowing of 30 million at 9% per annum. At 9% per annum. Require provide a comprehensive report to the company advising them on how to deal with competing borrowing costs for the year 2022, 2023 to 2024. Since they say you should provide a report, please, you are going to start with writing a report. They say report. Provide a comprehensive report. Please take note of your questions. It's very, very important. Since they say provide a report, you are to write a report as a consultant to the entity. And you are doing this on your letterhead, as it were, because you are a consultant. So let's quickly go. I've drafted something here. The MDC MBS Limited report on the need and how to capitalize borrowing costs. In line with provision of I-73, borrowing costs includes interest expense, amortization of discount premium, financing or lease, and exchange differences arising from foreign currency. I'm just trying to give an overview here. That's which is expected of you when you are writing a report. It is expected that all attributable borrowing costs for the acquisition, construction, production of qualifying assets should be capitalized as part of the cost of the asset. A qualifying asset is an asset that necessarily takes substantial period of time to get them ready for internal use or for CG building plans, etc. Note, however, that capitalization starts when expenditure for the asset is incurred, and hence when the asset is substantially ready for use. Also note that capitalization is suspended during any interruptions. Now let me explain this now. Any interruption means that when the production is halted or when construction is halted, borrowing cost does not suffice. Anytime there is a halt, there is a glitch, there is a maybe technical malfunctioning and the likes, but it's just there is a suspension and you can ascertain that there is a suspension. Borrowing costs do not cover that period of time. In other words, you are not going to pay the interest for that period of time. You are not going to you are going to pay the interest of the financiers, but you are not going to recognize it as part of the cost to the entity, meaning that the interest that is going to cover for that period of suspension will be expense, will be taken from your profit or loss for the current accounting period. Please take note of that. So I go and I concluded by saying final touch appendix for the workings which we believe is substantial to guide the further calculations on borrowing costs. We can be reached for further material training and explanation. For as much as I can, consult Franca Michael is the one writing the report. You can use your name when you are writing the exam. Very, very simple a report. And then you go to the appendix. We have to determine the borrowing cost to be capitalized. So quickly, let's go and we do it together. Yeah, 2022. I told you the first thing first. Step one. Step one is to determine the weighted average expenditure. How do you determine it? We're told that so that I won't be coming back and forth. I'm going to just copy this this very particular one, take it down to that place. So we're told that the expenditure were made as follows. In March. So now I can easily use this one. So let's go. I told you how to do it is to prorate it based on the number of the numbers of months. This one was taken in the month of March. So we have to determine it. We have 5 million multiplied by March to December is 10 months. 10 divided by 12. Is that also? Plus this one is taken in the month of June. June to December is how many months? 7 months. Plus 10 multiply by 7 divided by 12. Remember what I told you? You are only going to pay interest on the month to December. So that's what we are trying to calculate here. The other time I was trying to explain to you that you can do it this way, or you can just do it directly, for, exam purpose. You can do it this way. All of this one multiply by, what is the general, the borrowing rate is 12%. I can still remember, yes. Multiply by 0.12. You can do it this way. And then whatever answer that you have will just be the borrowing cost directly. Multiply by 0.12 plus the last one is 15 million. 15 multiplied by, it was taken in September, October, November, December. That's how many months? 4 months. 4 divided by 12 multiplied by 0.12. It's as simple as this. So we have it like this, and then we have it like this, right? Okay, sorry, apologies. Okay, so that is that for that. Let me punch your calculator as we are learning together. So let's see, what do we have? Total what we have is what? Because it is you that will help me to complete it. You can do it this way, or you can choose to also do it the way we did it before, that you determine first the weighted average and then multiply. This one, now what I'm doing here is Okay, let me take this one up so that year 2022 determination of borrowing cost. So the borrowing cost will now be equal to directly this one, or use below method, or use below method is the same thing. You are going to arrive at the same answer. Determine first the weighted average cost of capital loss. Okay, loss. Okay, so whatever you have equals to, I don't know what you are going to get, but you have to get it. I'm not with my calculator. It is you that will help me to do it, and that is that for that. Then step 2 now, we're told that whatever you have in step 1, you multiply it by the general borrowing rate, which is 0.12, and then whatever you have will be the capitalized borrowing cost. Please take note, it's as simple as this. There is nothing difficult in borrowing cost. That is everything that you need to know. However, there is also one thing that you need to know clearly. Whatever that is not directly attributable to borrowing costs, you must always expense it. Please, under your P or L, expense it. But whatever it is that is directly attributable, you must recognize it as a cost to the asset as it were. Please take note of that. Very, very important. So, presentation in the financial statement. All our borrowing costs I've explained earlier, they are to appear as part of property, plant, and equipment under the non-current asset, whereas you credit borrowing costs to finance costs under your P or L. Please take note of the following exclusions from this standard. Number 1, any asset that is measured at fair value, like biological asset, they are not to warehouse borrowing cost. Any asset that is measured at fair value, there is no way you can in any way attach what is it called, borrowing cost to them. That is, any item, any asset as it were, that is being carried at fair value, they are not to warehouse borrowing costs. And then number 2, any asset that is already in use, or any asset that is already on sale, cannot warehouse borrowing costs. Please take note of that. Very, very simple standard. So like I mentioned, borrowing costs appropriate. It's what one of the basic standard that help us to appropriate whatever it is that is being calculated as our borrowing cost, so that we can put them appropriately and adequately. So basically, this is all that is under borrowing cost. Another thing again before we conclude the class is you need to know that whenever you borrow money, for specifically for a project, that is for the construction or the production of a qualifying asset, there may be some time that we have what we call the idle funds. And what does that signify? Let's assume that, for instance, in this question that we have looked at now, okay, let me just copy that example. Where is it? In this question that we have looked at now, let's assume that the company actually began construction. Let me copy this so I won't obstruct it. I want to demonstrate something here. Now look at it this way. The company actually began illustration next. Now, the company actually began construction of Nimble on 1st of March 2022 with the following expenditure. How much is this? 5 million, that's 30 million. Now let's assume, okay, sorry. Let us assume that the entity borrow this 30 million for the purpose of constructing this plant, for the purpose of constructing the plant. Constructing the plant. Now, additional information. We were now told that any idle fund are invested at 10%. At 10%. In other words, now what I'm trying to explain is this. Okay, wait, hold on. The entity borrowed 30 million for the purpose of construction of this plant on 1st of March 2022. Let's just assume the year is 2022. Now look at it this way. Any idle fund are invested at 10%. Now look at what I'm trying to explain now. They borrowed this money on the 1st of March 2022. Is that not so? Now, when they borrowed this money on the 1st of March 2022, they pull only 5 million naira from this amount of money for the construction. That is in the month of March. Meaning, from 1st of April to the 31st of May, this fund, the 25 million that was remaining, was idle. You understand? Was idle, was not in use. But they said that any idle fund, according to their additional information, any idle fund, they are to be invested as they are to be invested at what is it called? At 10%. You see, whenever you invest the borrowing fund, whatever it is that you get as an income will be deducted from the borrowing cost. Will be deducted from the borrowing cost. Please take note of that. So determine the borrowing cost. How do we go about this? The first thing first that we will determine 10 million naira at, sorry, I'm just saying it, at 10 million naira at 10% per annum for the purpose of this construction of this plant, as it were. So our answer now, the first thing first is to determine the borrowing cost. Step 1, determination of the borrowing cost. Now I told us that once it is specific, all that you need to do is to multiply the calculation rate will be the specific rate multiplied by the specific principal amount. So our borrowing cost, which is BC, will be equals to principal amount is 30 million. Now multiplied by the specific interest rate, which is 10%, multiplied by 10%, and then that will be equals to how much? 3. 10% of 30, that is 3 as it were. So that is 3 million. So now you have determined this. But they said that any idle fund not utilized will be invested at 10%. Now this idle fund that is not utilized, you are going to determine whatever amount it is and then you will now remove it from the borrowing cost, as it were. So now let's determine step 2. Let's determine step 2, determination of uh, investment income from idle fund. Now the first one is the one for 1st of April to 31st of May. 1st of May. That will now be 30 million was the borrowing, minus 5 million was used in March. So the balance will now be how much? 25 million. So we were told that they invest and they get their investment is returning 10%. So the idle fund, the investment income here will now be equals to 25 multiplied by the 10%. Please take note of that. Multiply by 0.10, and that will be equals to 2.5 million. 2.5 million. Please take note of that. Sorry, please. 2.5 million. Okay. Then we were also told that between June, that is 1st of July to 31st of August, the fund was also idle. Is that also? We can see there. The fund was idle. So we have to also determine that. Since the fund were idle at that point in time, we are going to determine our second is the one from 1st of July to 31st of August. To 31st of August, and that will be the amount utilized now will now be 30 minus 5 minus how much is the one that they use in this thing? Minus 10. Minus 10, and that will be equals to 15. The idle fund that was available between that period to September is 15. So our investment income will now be equals to 15 is multiplied by 10%. Multiplied by 10%, and that will be equals to 1.5 M, as it were. 1.5 million, 15 million, 2.5 million, 25 million. And so that is that for that. And then we were also told that the last one was September was the last time that they use it, and there is nothing else that we are going to check out again. So you had the total investment income. Total investment income equals to where is it now? Sorry. Total investment income will now be equals to 1.5 that's 2.5 plus 1.5, and that will be 4 million as it were. So you have 4 million as it were. So if you have 4 million, that equals to 4 million. How much was the borrowing cost that we determine? 3 million. So it means that We cannot recognize any borrowing cost on this very particular asset. Rather, we are going to recognize investment income of 1 million in the statement of profit or loss. Statement of profit or loss. Please take note of what we have just done. This is an assumed question, so it can happen this way. But let's assume that the borrowing cost that maybe possibly we get is 6 million. Let's assume this the specific amount is 60 million, and then the 6 million is what we got. It means that we are going to take this total investment of 4 from 6 million, then the borrowing cost that we are going to report will now be 2 million. So it's as simple as this, and I'm sure that you understood all that I have said. It's very simple, it's very cheap this way. Just follow it, watch the video again and again, ask me questions in the comment sections, and I will attend to you appropriately. Thank you so much for your time. I'm sure you have enjoyed everything that we have done, and I think to God alone be all the glory. Thank you so much. Have a very wonderful time.